Hello and welcome everybody. Welcome back to Sectors Made Simple, and today we have two separate webinars put into one. Briefly, we're going to quickly talk about a promotion that we're offering here as a celebration of the end of May tricks, as well as after that we're going to get into our economic update for May of 2024 and a brief forecast for June of 2024. So, we have quite a bit to get through today, and two completely separate different topics to talk about, so let's get straight into the action. So, quick discussion here about the dashboard. For the past week, we have offered everybody access to the dashboard, and many of you have emailed us loving the ability to access these tools, and honestly, this is the first time that we've ever opened up access to our tools to anybody that wants to try it out. So, due to overwhelming popularity and to give you all more time to explore these tools and see if Sectors Made Simple is a good resource for you, we've chosen to extend that free access. So, let me talk a little bit more about that. But first, I do have to have this disclaimer. Everything I'm talking about here, any strategies or methods of using our tools, are meant for educational purposes and research purposes only. These are not forecasting tools. These will not tell you if Nvidia is going to go up or down tomorrow. Honestly, trying to predict if a stock is going to go up or down tomorrow is crazy. Honestly, you can have a goldfish going around a tank and try and see which direction it prefers to swim in. That is probably going to be a better predictor than 95% of the things out there. The reality is, nobody can predict future results. The best that we can do is understand what has happened in the past, where things are standing today, to try and make more informed decisions tomorrow. Now, the goals for this segment of the webinar are to tell you that we're extending free access. Again, we have received a lot of people emailing us expressing gratitude for the fact that for the first time we've opened up Sectors Made Simple's tools for anybody to try. So we want to give you all more time to do that. So from last Tuesday up through this upcoming Tuesday, June 11th, you will be able to access the entire Sectors Made Simple dashboard. Not only that, you will be able to access the beta version of the new and improved dashboard that is currently available to Sectors Made Simple subscribers and you. And later on, this also will become the new version of the dashboard. In addition, we hope that you enjoy access to these tools, and to help make the transition easier, hopefully, we are offering a special discount. This is not a discount that we are advertising. This is not something we're posting on our website. This is for the people that are joining us for these webinars, and we want to express our gratitude. So, this is a very exclusive offer, but this offer is only around for 1 week, until next Tuesday as well, June 11th. So, I'm going to tell you a little bit more about that promotion. Plus, I want to share with you all a couple of simple ways that you can start using Sectors Made Simple to invest. I'll provide some examples for you all. And then finally, I'm going to share with you all a few of the upcoming changes that we'll be making to the beta version of the dashboard to make it even simpler to use. So, let's talk about that promotion. Again, this is not something we are blasting out and advertising to everybody. This is only for this webinar. So if you're here, congratulations. This discount is one of the largest discounts we've ever offered, and it is 20% off of your first subscription payment. So you can get 20% off your first 1 year, 3-month, or 6-month subscription. But remember, it's only for your first one. So if you purchase a 3-month subscription, that discount is applied to that first 3 months. If you purchase an annual subscription, that discount is applied to the first year. The code for that discount is just simply Matrix. Maytrix. And like I said, this discount is only available through Tuesday, June 11th. Now, We fully hope that before just jumping in with both feet, you go in and you try out the tools for yourself and see just how many possible ways there are to use the resources that we offer. I will sit up here and talk quite a bit about the value and the flexibility of our matrix strategies. But the reality of it is, those are only a small part of the resources that you get access to with Sectors Made Simple. So I want you to be able to go out and try some of these more creative and informative ways of using our data beyond just listening to what a strategy has to say. But of course, that is going to be a key way that you, and honestly me too, choose to use our tools. So go in, explore some of the returns of our matrix strategies. Don't take the word of a talking head on YouTube. Go check it out for yourself. See how well these strategies are performing and make your own decision from there. Also, this tool is one of the only resources out there that does a true comparison of the entire S&P 500. Many others will try and look at 1 month or 3 month returns of these different companies and then rank them accordingly. But that doesn't tell you who the leader is today, that just tells you who's done the best in the past month. Our tools not only show you who the leaders are today, but what companies have gained the most strength over time. So, I highly recommend going in and checking out the S&P 500 screener to see which companies are leading the market and help discover new opportunities for your investments. Also, while you're on the S&P 500 screener, try this out. Go to your favorite stock news website, check out any sort of recommendation list or stock watch list that you might find out there, and plug in those companies. As a reminder, over on our dashboard, you have the ability to filter by stock. So if we check out the dashboard here, what you'll see is under S&P 500 screener, we can choose tickers. Go here and paste in all of the tickers that you're interested in. This could be a list you get from anywhere, from your friend, from your dog, I don't care. The point is, I want you to see that this tool gives you a unique way of looking at a set of securities. So take securities that someone else has suggested, plug them in here, and look at them in a way that nobody else can. Also, this is not the first webinar that I've talked about the dashboard. We've taken a look at specifically the sector strength matrix. We've taken a look specifically at point and figure setups. And then last week, we took a look at all of the different tools. For every one of these topics, I've also included some various ways that you can use this tool for your investments. So, while we have access to the tools, spend a little bit of time. Go in, scrub through the webinars, see if there's a way of trading that seems interesting to you, and try it out. There is no limit to, you can only create 2 custom matrices during your free week. No, use the tools. They're here for you. Try them out. And if that's not enough, if you want more guidance or if you have specific ways you want to use our tools, please shoot us an email. These tools are something that we stand behind. We use them. We've created them from scratch because we find a large amount of value in them for investors of all skill levels. So if I haven't said a way that makes sense for you, or if you have a goal that you're wondering if our data can help you with, send us an email. My email is support@sectorsmadesimple.com. You email that, you get a response from me. So shoot us an email, ask me, hey, I want to learn more about how to find opportunities for trading puts. How could I use Sectors Made Simple's tools to find put opportunities for short-term day trading? Awesome. Let me explain. So again, I've offered a large amount of suggestions on ways to use our tools. If those aren't enough, or if you have more specific cases that you want to understand, send me an email and I can chat with you one-on-one to help you see how Sectors Made Simple can make your investment goals simpler to achieve. Finally, what's coming next? We are still working on the beta version of the dashboard. That's why it's called the beta. So, over the next few weeks, we are going to be making a few updates and improvements and adding a few new resources to this dashboard. So, I want to share with you all right now just what it is that we're cooking up. The first one is actually a new feature. We are going to be offering expanded point and figure charts, meaning that you can open up a point and figure chart for any security that we support, which is thousands of securities. You can go in, check out its point and figure chart without needing to go to another website or a third-party service to get those point and figure charts. Everything will be in the dashboard. Also, the point and figure setup screener. Right now, this screener only offers New York Stock Exchange companies. So we are working to add all of the NASDAQ companies to this list as well. Finally, para nuestra comunidad en español, estamos trabajando ahora para obtener y para poner traducciones para español en el Matrix y para los menús de ayuda también. So, what I tried to express there is that we are adding Spanish translations for all of the tools on the dashboard, as well as all of the help menus when you want to learn more about the tool. So expect to see those in the coming weeks as well. Also, for anybody that has been a frequent visitor of our webinars, you should know I love talking about the tools on the dashboard, but I also love creating spreadsheets. It is a very unique way and a very hands-on way for me to ask a question and then give you an answer, but also give you a resource to find that answer out for yourself. I don't want to just tell you, hey, if you're trading a Thursday strategy, you can trade it. You can place the order to be filled on Thursday morning. If you forget, you can do it Friday morning. Don't take my word for it. I created a spreadsheet, paste in a backtesting result, and see for yourself if that works. So we're working to improve and expand how many spreadsheets we offer, as well as making sure that these spreadsheets work with all of the new beta tools. And then finally, the big one, Matrix strategy alerts. Right now, if you're interested in a Matrix strategy and it trades on Thursdays, you need to set a reminder on your phone to go in and check the Matrix. You need to go through and find who the sector leader is, and then you need to go out and make the trade. That works for many people, and honestly, once you've done it once or twice, you can do it in about 3 minutes. We want to make it simpler. 3 minutes, too long. So what we are adding is the ability to sign up just using a one-click button. Sign up and receive email alerts whenever a strategy is updating its holdings. So, if you're trading a Thursday strategy, Wednesday night, once the matrix updates, you would get an email saying, hi, this Thursday strategy is selling this from last week and is buying this for this week. It's going to make it way simpler. You don't need to check the dashboard. You don't need to go in and figure out what is the sector leader yourself. Simply, you get an email that notifies you that the strategy is updating its holdings. Here is now what it is trading. You can sign up for multiple strategies or no strategies. And this feature is going to be included with any Sectors Made Simple subscription. So if you're interested in these alerts, you can join Sectors Made Simple and receive those alerts. This update is also going to be coming in June. So, May was a month chock full of amazing improvements for the beta dashboard and releasing the beta dashboard for you all to try out. But June, we are continuing to work on the beta dashboard as we get it closer and closer to the full release. Hope you all can take advantage of the tools that we offer, try them out for yourself, ask us questions, and be sure that you understand just how much Sectors Made Simple has to offer to make investing simpler for you. Awesome. So now that that all is out of the way, let's get on to the main topic for today's webinar. I want to talk with you all about May of 2024. What changed in the market, what changed in the economy, and what should we be paying attention to for the upcoming month. Again, disclaimer, because this will end up being a separate video. Everything I'm sharing here is my opinion and is based on historical results. Past results don't guarantee future performance. Please take everything here as an educational resource and research, not as financial or investment advice. Do your own research, come to your own conclusions prior to making any investment decisions. Cool. Next. What are we talking about? Again, these webinars are something that I do once a month with Sectors Made Simple subscribers. But because I wanted to share a little bit more about the matrix, and because honestly, right now we're making sure that everyone can benefit from this education, we wanted to still have this be available to everyone. So the goal today is very similar to our past monthly market recaps and forecasts. We're going to take a look at the returns of the different sector ETFs that we track, see which of these sectors have experienced point and figure breakouts, buy signals, or breakdowns, sell signals. We're going to talk about what key events shaped the market in May and what sectors benefited the most from these announcements. And then we're going to take a look at the overall health of the stock market. And finally, forecast, or rather, share a little bit of insight about what key events we should probably pay attention to coming up in June. So, let's get into the recap. Let's start off by talking a little bit about May market performance. April, for those that remember, was not a good month. We saw the vast majority of sectors post losses, and honestly, with no potential good news on the horizon beyond a couple of company earnings, that's where we thought it was going to be. But May was an extremely and overwhelmingly positive period. Now, there were a few sectors that did okay. And keep in mind, we're talking here about every single sector saw profits. So no one was in the red. But some sectors did enjoy larger gains than others. So to show you the full detail, here are the 1-month sector returns during May of 2024. What we see is the S&P 500 itself rose 5.4%. This was due largely to titans of this index within technology, communication services, and utilities. Funny enough, utilities was one of the best performing sectors this month, helping to raise the S&P 500 above that 5% gain mark. Again, we see the vast majority of sectors with returns in the 1 to 3% range. However, 4 sectors do stand out here. Technology with 8.2%, utilities with 7.7%, communication services with just shy of 6%, and real estate with 5%. So again, it's clear that these 4 sectors stood out above the rest, but just saying they did well, cool. Anybody can go look at a returns chart and say, these sectors did well. We want to take it a step further, and we want to help to explain why. Again, it is always impossible to draw a single reason for a stock or an ETF going up or down. But what I wanted to do was find a few key reasons? What were the largest drivers of change, in my opinion? So, for the four sectors that we just mentioned, technology, communication services, utilities, and real estate, here are the key reasons that we feel these sectors went up. Technology, probably the easiest one to talk about. NVIDIA. I'm not really going to say much else, just NVIDIA. We'll come back to NVIDIA later, but I don't think you need me to tell you that NVIDIA has been on one of the craziest rises or one of the craziest bull runs of any company I've ever seen. And based on their earnings, I don't know if that's going to slow down anytime soon. So we'll come back to NVIDIA later, but for right now, why did technology go up 8%? Look at NVIDIA. That's why. Utilities. This one was very interesting because utilities is historically a defensive sector. It is a sector that is supposed to never really be a leader, but will always be doing okay. It is a defensive sector, meaning that during times of economic uncertainty, market pullback, or bear markets, utilities is expected to weather that storm the best. So why is utilities rising so much? Well, one of the reasons that we came to was the fact that AI is so huge right now. Not just that, AI has a large-scale impact on technology, first and foremost, but also utilities. Because one thing that AI needs just as much as it needs high performance, power consumption tools and hardware is power. So many energy producers and distributors benefited greatly throughout the first couple of months, throughout the past few months, really since March, April, and May, we have seen utilities companies rise to market leadership. Utilities has been one of the strongest sectors, if not our sector leader, for over a month now. Due largely to the fact that the vast majority of the sector, and really the majority of the market cap of the sector, has benefited due to the increased demand due to AI expansion. So, technology, being the hub of semiconductor companies and AI, is also positively impacting utilities as a result. Communication services, while Google's earnings were technically in April, the majority of the improvements that the company saw spilled over into the first half of May. So Google's earnings contributed heavily towards communication services price increase, but also we saw a number of telecommunication companies also perform exceedingly well. The reasons there are a little bit more nebulous. There's no clear, this was the reason. So I'm not going to start saying one reason or another, because the reality of it is, it's just an industry that is performing well right now overall. There doesn't need to be some divine reason as to why. Finally, real estate. Real estate, I would not say is a sector, and this is my opinion, is not a sector that is rising to market dominance. This is not going to become our new sector leader within 2 weeks. What's happening with real estate is not a surge, not a rally, it's a recovery. Real estate has suffered greatly over the past few months as confidence surrounding when we are going to see federal interest rates start to decline. As the confidence surrounding that has decreased, the longer interest rates stay high, the harder it is to borrow money, the more expensive it is to borrow money, the less people are going to be investing in real estate or buying new offices or building new buildings. That's the reality of it. So, while I think that positive, or rather not negative, economic data is to thank for real estate's increase in price, I don't think it's the sign of some massive rally behind this sector. If we look, for example, at its 6-month returns, what we find here is that, yes, it's technically up over the past 6 months. Yes, from April it is up 7% from mid-April, but that's not, this is essentially a sector that is going sideways. We're seeing ups and downs with economic news, but until we genuinely see interest rates start to go down, or we have certainty of interest rates declining in the very near future, I can't see real estate rising to any semblance of sector leadership. But you can't discount the fact that they still did post a 5% gain last month. So, let's now move on to our breakouts and breakdowns. There were not many, but there were a few notable breakouts and breakdowns throughout the month. And they are all out of order, so you get them all. On the breakouts, or buy signal section, we find 3 different ETFs all going on breakouts. For this one, in contrast to previous months, I've tried to include a little bit more information about the type of breakout it is. There are 2 main kinds of breakouts that we can have. Both are when we have our current positive trend, or rather our current positive price direction go above the previous level of resistance or the previous column of X's. This can either be a confirmation, meaning that it was already in a buy signal, it just went down a little bit and then went back up. Or it could be a reversal. The reversal is when we go from a sell signal, a breakdown, into a new buy signal. So for the S&P 500 ETF SPY, it went on a breakout on May 15th, but that was a confirmation of a previous buy signal. Technology, or XLK, went on a breakout. Went on a breakout on May 15th as well. However, in contrast to SPY, this was a reversal from a sell signal that was hit back in April of this year. Then we have Staples, XLP, with a breakout on May 9th, again a confirmation, while XLE went on a sell signal breakdown on May 29th. That was a reversal from a previous buy signal. So 4 new signals, 3 of them buy signals, and then 1 a sell signal. Next, let's talk about relative strength. What I want to show you all is where sector leadership sat at the beginning of May compared to where it sat at the end of May. And I want to take a closer look at how sector leadership lines up with our sector rotation chart. So looking here at the current matrix, we notice a few very interesting things. The biggest one is not who the sector leaders are, it's where these sector scores are. For example, for utilities, we saw a long-term strength of 4. These scores are out of 11, by the way. So we find that the majority of long-term charts for XLU are not in positive indicators. Whereas its short-term strength, it's got a perfect score. It's beating every sector for short-term strength. What that tells us is that utilities short-term has been doing very well, but it hasn't been able to convert that short-term strength into long-term leadership. As a result, its total count was only 15. In contrast, we have energy. Energy used to be a clear sector leader. However, through its decline over the past few months and into May, we found that it has lost significant short-term strength. But again, it has not lost that long-term strength just yet. So as a result, we find that energy is still the third strongest sector at the moment. Rather, tied for second strongest sector. So again, we are seeing two very interesting and contrasting sectors towards the top of the matrix. We are finding utilities that has high short-term strength but low long-term strength, and energy that has that long-term strength and that low short-term strength. So if I were looking at this, what I would immediately say is, let's see what happens. Where do these two sectors line up in May? Do they gain the strength that they are missing, or do they lose the strength that they are holding on to? Only time will tell. But how does that line up with sector rotation? If we look at this chart, which helps us to understand what sectors are supposed to do better or worse during different sections of the market and economic cycles, we can see just how much sector rotation is the leading force. Remember, sector rotation is like the current in a body of water. It's going to move things left and it's going to move things right, but the reality of it is there's still wind, there's still what direction your motor is going or the direction you're paddling. There are so many other things that influence the direction of the market. So seeing things be very grouped up together, clear sign that sector rotation is what's driving leadership. See things very spread out, it's an indication to us that other things outside of sector rotation are causing the market to shift. So, circling the sectors that are our current leaders, we find energy, financials. The sectors that were not leaders are technology and real estate and healthcare, with utilities also being current leader. So we seem to have a decent concentration of these market top and bear market sectors, which doesn't really line up very well with what we would expect to see in more of a market bottom, bull market kind of situation. But again, we're not seeing a clear grouping where we see these positive sectors on one end and negative sectors on the other. So let's take a look at where sector leadership shifted to by the end of May. Check this out now. We have seen energy's strength, its short-term strength, go to 0. That is the lowest possible strength that it can have. But it is still holding on to that long-term strength. Likely because that sector did have so much strength moving into the first few months of 2024. Seasonality was working in its favor. Energy is a sector that performs extremely well when there is more reliance on thermal energy, things like oil or coal. Moving out of that seasonal trend, we find that that sector is continuing to lose strength, but it is not completely lost that strength just yet. In contrast, utilities is gaining that long-term strength. Utilities has gained a significant amount of long-term strength, helping it to continue to be the sector leader despite other sectors like communications rising up and challenging it. Again, we're now a few days into June, so we have a little bit more market insight, and we can tell you with more certainty, utilities is still the sector leader. I really hope that's true. Let me make sure. Before I stick my foot in. Let's make sure utilities is the sector leader. By the way, while we're waiting for the matrix to load, so funny enough, yesterday, utilities did lose sector leader, the top position on the matrix, to communications. However, both of them are still neck and neck. Now, the very interesting thing here is technology. Technology had a significant rise throughout May. and on the very last day of the month. I need to find the image from the newsletter because honestly, this 1 week momentum table was one of the craziest things I've ever seen. Aha. This was the 1 month momentum comparing the matrix from May 31st to May 24th. Technology was one of our sector leaders until the very last day. The very last day of the month, it lost -10 in short-term strength. Keep in mind, the highest possible score is 11. So it had 10 and lost it all in one day. In the history of us tracking the matrix, I have never seen a sector lose that much relative strength in a single week. And keep in mind, energy had a great month. Energy did an amazing job last month. But in the last day of the month, energy suffered. So, as a result, we do see that technology. We found that technology had one of the largest drops we've ever observed on the matrix, resulting in it having a total count of just 6, despite the day before it having a total count of 15. That goes to show that sector leadership can and will shift at any given moment. That is the value of having a tool like the matrix. If all you're looking at is 1 month returns, you might miss the fact that technology hit an absolute relative strength wall last week. That is a large amount of insight to have if you're looking at sector rotation or trading sector ETFs. If all you're looking at is returns, technology looks like the leader. If you have relative strength, if you have the matrix, you understand that that relative strength can be taken away in an instant if the sector begins to underperform. So now, where do the new sector leaders line up with our relative strength chart, or with our sector rotation chart? Well, utilities is still the leader. Now we have communication services, while discretionary and healthcare continue to be laggards. And then finally, financials keeps its top spot, one of its top spots on the matrix, while real estate has fallen back down because of the hesitancy, I believe? The reluctance to lower federal interest rates in the coming meetings. So, what do we find taking a look at all these charts? Well, unfortunately, sector rotation, as far as the market and economic cycles are concerned, is still a little bit jumbled. There are way too many forces that are not sector rotation that are driving the market. So, in my opinion, I believe that sector rotation is not a leading force in the stock market, and other forces, both economic and news-wise, are the real driving factors behind shifts in the market. So, let's get a little bit more specific. What are those key factors? I did jump the gun a little bit, but in my opinion, we're looking at 2 things. AI, not even a sector, just AI, and economic data. Let's talk about it. Now, let's start off here with AI. And let's take a look at how AI as an industry, not really an industry, but more an idea, why it's grown so much and how it changed throughout May. So, why is AI driving the stock market right now? Well, honestly, we can explain that through a variety of reasons. First and foremost is probably the reason that you and I would know because it's also the thing that you and I have probably interacted with. I'm willing to bet that the vast majority of the people who are watching this webinar have either tried out ChatGPT or have done their homework using ChatGPT, written an essay, or an email. The reality is ChatGPT and generative AI are everywhere. They are only getting better and better, and these are creating new processes and causing massive disruptions in many different industries across the entire professional world, really. Anybody and everybody that has some creative element to their job is probably leveraging these chat AIs as an additional resource in their decision-making processes. Because of that, it is creating a level of dependence on these resources. So, that's valued. But unfortunately, or fortunately, depending on how we want to look at it, the reality of it is that AI is the result of machine learning. And machine learning is extremely resource intensive to do. These are supercomputers that are running all day, every day. The hardware in them costs millions. There are only a few companies that actually create that hardware, but everyone's using the hardware. So the reality of it is that the majority of large-scale companies are either licensing generative AI and AI from large companies like OpenAI, or are investing heavily through research and development into AI of their very own. For that, we can look at something like Google's Gemini, or Meta, working on their own generative AI as well. Kind of. It might go the way of the metaverse, but you never know. The reality of it is, though, a key line item for most large-scale technology companies these days is AI. So, because of that, they're investing heavily in infrastructure, but also heavily in the energy and resource costs that these projects consume. So, that's part of the reason why I feel that utility surged so heavily over the past few months. We need a lot more power. These supercomputers are consuming a hilarious amount of power. For some idea, I enjoy computers. You've noticed I'm a little bit of a nerd. I've built my own computer. I've built multiple computers. The majority of these computers are, I would say, mid-range. They're not the best, they're not the worst, but all of them consume somewhere in the range of 600 to 700 watts. And the majority of that is the graphics card. Modern graphics cards for just everyday people computers are in the range of 700 to 800 watts. The GPUs that they're using for OpenAI's research or for Google's research, we're talking thousands of watts. So that's a lot of power that needs to be generated and then distributed. Every company along that supply chain of getting power to these companies is going to benefit. And again, it should be clear and pretty straightforward that NVIDIA has been the biggest benefactor of these changes. NVIDIA has always been one of the largest, if not the largest, name in graphics cards and video processing units. And guess what? Machine learning loves video cards. AI and machine learning are powered by these graphics cards. So, the more graphics cards are in need or are in demand, the more NVIDIA, and to a lesser extent AMD, will benefit from it. Now, are we going to have webinars about AI? And how is it going to benefit or affect investments? Great question. Honestly, let's do it. Next Tuesday? Sound good? Next Tuesday we'll talk about AI? That'll be super fun. It's been a while since I've gotten to do AI as a webinar. So, yeah. For SMS subscribers, next Tuesday's webinar is going to be on AI and the impact that it has on stocks and also what potential future impact it might have. Now, let's talk more about NVIDIA. NVIDIA announced their earnings on May 22nd. And in our April market forecast, I said that my opinion is that this earnings report is going to be extremely important. Not just because of the market cap that NVIDIA has, not just because of the growth valuation that NVIDIA still holds on to, but mostly because the health of the semiconductor industry relied on it. Many major companies within semiconductors were revising EPS and revenue estimates downward for quarter 2, citing lower global demand for things like smartphones. NVIDIA, smartphones aren't a key revenue driver. Instead, what is a key revenue driver is AI and graphics cards. So, what happened? Well, they were outstanding. I watched the entire thing and I was honestly glued to my computer the whole time. Every single thing that came out of the presenters' mouths just provided more and more backing behind why NVIDIA is truly the king of this industry. In quarter 1, their EPS and revenue grew and surpassed all analyst estimates. And in contrast to other semiconductor companies, they announced positive guidance for their quarter 2 revenue, which is outstanding. They announced that they will be offering dividends for quarter 1, and that their dividend payouts are going to be about 150% higher than they were for their previous dividend payouts. And then finally, they announced a 10-to-1 stock split. What that means is that for every 1 share of NVIDIA there is right now, in July, that will become 10. That is huge news. It is going to open up NVIDIA to more retail investors. It is going to allow NVIDIA to offer shares as benefits or offer stock options as benefits for employees. So all of this compounded together to offer up an incredible earnings report. And if anyone's been following NVIDIA's price since this report, it surpassed $1,000 for the first time and is well on its way towards that $1,200 mark. So, where did this come from? How has NVIDIA become that company? Well, like I said before, NVIDIA has always been a staple of the computing and computer components world. If you want to buy a graphics card, you have 3 options: NVIDIA, AMD, or Intel. Poor Intel. They are trying to break into that market, but it might be a little too late. But NVIDIA has truly been the dominant force in this industry for a very long time. And their growth has exponentially increased as the amount of research and development and learning that has occurred in AI has grown. NVIDIA is the largest producer of chips and graphics cards by revenue, and those chips are an integral process of AI and machine learning. So obviously, machine learning and AI becoming the hot thing right now, NVIDIA has been the biggest benefactor of that improvement. NVIDIA stock is up 150% in the past 6 months, 200% in the past year, and 3,100% in the past 5 years. My opinion, with the positive guidance for the revenue in Q2, and the fact that AI is only growing more powerful and honestly has diminishing returns. The more and more AI improves, the harder and harder it becomes for AI to improve more. So if you wanted 1% improvement in AI 4 years ago, it wouldn't take very long and it wouldn't cost very much. If you want 1% improvement in AI today, you're looking at millions of dollars worth of hardware, investment, time, and energy. So the question is, where's it going to go next? And unfortunately, no one really has the answer, and I'm not going to start to speculate about when NVIDIA is going to slow down. But as far as the revenue guidance that they have offered is concerned, Q2 is probably not going to be that time. Now, let's shift focus a little bit and talk about economic data. Outside of the key sectors and industries that we've already talked about, the majority of the movement in other areas of the stock market has likely been the result of economic data and investor confidence surrounding these data reports. So the big questions here are, when will federal interest rates start to go down? And will we see a recession in 2024? Well, that second question we answered fairly recently. Back in our April 2024 market review, I did a full-scale analysis of my opinions of our current standing. It was one of the largest sets of resources that we provided from a webinar, so I'm not going to just repeat most of the things that I said there. Go check out that full webinar. So let's take a closer look at this first question, because I think that that's where we actually do have new information to share. First, why do interest rates matter, and when will they go down? Well, the reason that they matter is because interest rates being high puts stress and strain on our economy. The more strain there is, the more expensive it is to borrow money, the higher unemployment will go. If people are losing their jobs, they're going to decrease how much they're spending. If they're not making as much, or if the cost of things starts to go up and outpaces revenue growth, which it is, people aren't going to spend as much. So a decrease in consumer spending will then cause more strain in the economy because people aren't spending as much, companies aren't making as much, they lay off more people laid off. This is how recessions start. So, how far along in that process are we? No one knows the answer, not even the Fed. So that's why investors, economists, and the Federal Reserve pay so much attention to these regular economic updates we receive, because nobody knows what things are going to be until we actually get the data to back it up. So that's the importance of these economic releases. And each report gives us more information to understand if the Fed's current policies are effective. And also, when will the Fed start to say, our job is done, we can begin to taper interest rates back towards a more sustainable rate. Let's not hear from me, let's hear from the Fed. We got to hear from a number of different sources within the Federal Reserve System throughout May, but I wanted to highlight two of them. The first was the FOMC minutes summary. A few weeks after each FOMC meeting, they publish a summary of the different topics that were discussed during that meeting. So in May, they announced the summary from their April meeting, where we learned that the Fed was uncertain if current policies and current interest rates are effective enough to say, this is where we should keep things. Also, they stated that 1 month of results isn't really good enough. They need and want to see consistent months of improvement before they can start to say that their job has been accomplished. This was the more moderate take. The more hawkish take once again comes from Minneapolis Fed Chairman, or Fed President, Kashkari. Kashkari, in a CNBC, I believe, in an interview with a news organization, stated that many more months of positive, meaning good inflation data, are needed to give him confidence that it's appropriate to dial back federal interest rates. Once again, he is coming in with a very hawkish, a very negative tone, stating that the Fed is paying attention and that they won't really make any changes until they're confident that the economy is moving in the correct direction. But he didn't stop there. He also hinted at the possibility of more rate hikes, increases throughout 2024. That was bombshell news, and that definitely provided a lot more stress and weight behind the subsequent economic reports that we got. Now, I do really quickly want to mention this. With the way that FOMC voting works, Kashkari does not currently have a vote within FOMC decisions. So the hawkish tone that he is taking on is not a opinion that will result in federal interest rate adjustments, or won't have an impact on federal interest rate adjustments. The way that it works is that different branch chairmen rotate in and out who has voting rights. So while he does have a place in FOMC meetings, he does not currently have a vote. So this does not give us an idea of where federal branch members or where voting members are looking for the immediate term changes. But let's go through some key economic data reports that we got through May, talk about what the results were, and if they matter or if they don't matter. So first, consumer sentiment. Consumer sentiment tells us how confident people feel about the direction of the economy, but also their spending, how far their money is going, and all of that. Consumer sentiment declined significantly and was well below analyst forecasts. Again, that might not seem like a good thing, but if what we're looking for is signs of economic slowdown, not crash, that is a positive sign. CPI inflation did rise in April, but was still in line with analyst forecasts. Not much change there. Purchasing Managers' Indices, or PMIs, were all above expectations and are in positions of expansion, meaning that across service and manufacturing sectors, or rather service situations, we are not seeing any sort of dramatic crash or recession in those areas. GDP. This was one of the last announcements we got, but also had one of the largest negative impacts on the market, albeit it was a very temporary impact. We found that growth estimates had stayed steady at their 1.6% estimate, but were still below analyst forecasts prior to that announcement. And then finally, PCE was in line with estimates, and personal spending decreased. All of that comes together to basically say, things are moving, nothing's moving in the wrong direction, all fairly good news as far as I'm concerned. So again, to summarize all these data points, my opinion, inflation rising is not an immediate cause for concern. This is something that is expected and is not contradictory to the goal of a soft landing for the Fed. Seeing personal spending declining is a positive sign that current economic tightening is working. And the GDP report again was the big event from last month and did have a significant impact on stocks in the short term. That 1.6% growth rate was quite a bit below the forecasted 2.3%. And immediately following that estimate release, we saw that the Fed Watch tool from the Cincinnati Fed indicated a massive drop in forecasting for Q2 results as well. This is all lining up to show us that there is economic slowdown right now. We are seeing a decline from Q4 results to Q1 of 2024 results. Q2 results are being revised downward right now, indicating that we might see that 1.6% number either stay steady or decrease again. So all of that are positive signs that, in my opinion, economic policies are working, albeit slowly. So, how do all these reports impact interest rates? I'm going to fly through this because honestly, it's cool if you find it cool. If not, it's going to say the same thing over and over. There is a tool called the CME Fed Watch tool that tracks the probabilities of federal interest rate changes in all future meetings. So, looking at the probabilities of decreases for the upcoming meetings from the beginning of May, we found that the June meeting had a 9% probability of a decrease, a 28% chance by July's meeting, a 54% chance by September's meeting, and by the end of the year, the majority, around 65% of forecasts, expect that the federal interest rates will be between 4.75 and 5.25%. Cool. The big takeaway here, though, is all of those estimates are below are worse than what the Fed thought they can get rates down to. After every second meeting for the Fed, they announce or provide what is known as the Summary of Economic Projections. It is their forecasting of where they see key economic data points at the end of each year, 2024, 2025, 2026, and on. In March 2024's meeting, their Summary of Economic Projections forecasted a federal fund rate of 4.5 to 4.75%. The vast majority of estimates do not expect it to get there anymore. Okay, that's May 1st. How about May 31st? Well, unfortunately, we saw a lot of these probabilities get a lot worse, but through some of the end-of-month reports, like the GDP report and the PCE inflation, we did see some of these forecasts recover. But by how much? Well, we found that there is now a 4.4% chance of a rate decrease in June's meeting, which is worse than May 1st. 16.2% chance of a rate decrease in July, again, worse than May 1st. 55% chance in September. It was 54% back in May 1st, so we're going to call that even. And an 85% chance by December, which is a sharp improvement. But again, only 11% of forecasts believe that the Fed will reach their target of 4.5 to 4.75%. That's where things ended off on May 31st. Where are things in June? Well, as Erica just pointed out, this month we will get another FOMC meeting. In addition, we will also get an updated Summary of Economic Projections. And honestly, my opinion is because of the crazy swings that we've seen in forecasts for interest rate changes, this document is going to be an absolute, just not nightmare, but it's going to be a big eye-opener for investors and economists. So I predict quite a bit of shift and quite a bit of volatility in the days leading up to and the days of the Federal Reserve's meeting. Again, right now, we are hearing two very different tones from two very vocal FOMC members, Chairman Jerome Powell and Branch President Kashkari. Powell is being a little bit more optimistic. Kashkari is being much less optimistic. So who is more correct? I'm not going to tell you. We're going to have to wait and see together. So, with that said, here are some key economic dates that we will be paying attention to, and you probably should as well, throughout June. Before market open on June 7th, we will get May's unemployment rate. Again, unemployment is a key part of defining recessions, so seeing unemployment remain low is a positive sign that economic improvements are not resulting in genuine job losses. June 12th, before market open, we will get CPI inflation data for May. Also, during market hours on June 12th, we will have the second meeting, or the second day of meetings for the Federal Reserve, which will result in an interest rate decision, a new summary of economic projections, and a press conference with Chairman Jerome Powell. The next morning, we will get the PPI data for May. This tends to be a leading indicator for inflation, so seeing this number decrease would be a positive sign that we might see inflation decrease in the coming month. The next day, we will get consumer sentiment data from the Michigan survey. This again will give us insight to how strongly consumers feel about the direction of the economy. June 18th, before market open, we will get retail sales data. June 27th, we will get the final Q1 2024 GDP numbers. And then lastly, on June 28th, PCE inflation. June is going to be an extremely crazy month. There is lots of economic data activity. There is lots of different events that can shape and impact the stock market. And genuinely, this is probably one of the most important months to follow. These very, very influential economic reports. We will be tracking how these different events impact the stock market. We will be sharing some of our key insights over on our social media channels, so if you don't follow us there, do check them out. And again, SMS subscribers will continue to get updates in our members' webinars about how these different events are impacting stocks in real time. Again, just to put a nice little bow on everything, for this week, for the remainder of the week, we are offering that unlimited access to our Sectors Made Simple tools for anybody that wants to try them out. So, if you've always wondered if SMS tools are right to help your investments, go try out the tools, email us with any questions you have, and remember, until June 11th, we are offering that 20% discount if you use the coupon code MAY, MAYTRIX. In the meantime, thank you all so much for joining us. It was such a pleasure to be able to open up these webinars to everybody throughout May and today as well, and we hope that you continue to find our resources and education helpful to making investing simpler for you. Thank you all so much. Hope to see you all back very soon. Bye.